150 points away from 11,000. How much have we added in last 1 month? Let's look at that 1 month chart for the Nifty. And the strength in the market is, it's not puzzling, but it is surprising surely. In last 1 month, Nifty has appreciated by about 4%. Isn't that heartening? I mean, this is one of the best starts we've had for global financial markets. This is one of the best calendar starts to global financial markets, and that's very, very encouraging. Is it only about liquidity? Well, maybe not, because there is evidence of recovery, at least in global markets. There is evidence that US tax bill is going to boost earnings for US companies. The comment from Apple last night seems to be indicating that the whole objective of tax bill seems to be moving in the right direction. So there is a lot of global optimism, there is a lot of local hope, and there is high curiosity ahead of the all-important event, which is Union Budget. But where do we go from here? And how will 2018 be different from 2017? Now let's discuss all that and much more with Saurabh Mukherjea. Saurabh, good morning. Thank you for joining us. You know, the minute I look at the market, it just reminds me of a pan which my mother uses. It's made up of Teflon. Doesn't matter what you put on it, it never gets scratched. So what's happening to the market? They are behaving in the same manner. I mean, markets have become Teflon coated.
I think Jeremy Grantham, the GMO chief, put it very nicely. I think on 3rd of January he published a note saying that he expected equity markets to be in melt up mode over the next 6 to 24 months, and specifically in the context of the US bull market, he's saying that we're in the sort of final lap of a 10-year bull market. I don't know whether we've had a 10-year bull market in India, but it certainly feels in India that we are in melt-up mode, because fundamentals clearly are not driving this rally. You've got the Nifty or the Sensex, whichever index you care to use. You've got both of those at PE multiples which are comfortable 2 standard deviations above their 10-year averages, and that's after forecasting, that's after factoring in punchy earnings for double-digit earnings growth for the first time in 5 years in FY19. So it's not fundamentals, but clearly that this is the nature of markets, this is the nature of stock markets. Once confidence is high, once across the world people believe an economic recovery is on the horizon. In our country, we are clearly seeing tangible signs of an economic recovery in India, and alongside that you have inflation pumping up as well, which in turn boosts earnings growth. It's very difficult then to control animal spirits. So we've got an incredibly strong bullish sentiment in India. I think FII sentiment across the world has become very bullish vis-a-vis global equities. I don't think I've seen Western fund managers so happy in a long time. So all the signs are that this party will continue through the year, barring some unforeseen political events at home or abroad. The signs are that we're going to have a bit of a wild party over the next 6, perhaps 24 months, if Mr. Grantham is to be believed.
What should we expect in terms of an price action? Because when we are staring at a market which is largely dominated by liquidity stroke, the Johnny-come-lately crowd which are feeling left out, what happens to the fundamentals? What happens to the price action? What happens to the basic parameters which fundamental experts like you track?
I think what both fundamentally oriented people like me and more speculative people, I think what all of us will now do is we'll sort of say that, look, if we are in what looks like a clear economic recovery, let's focus on cyclical sectors where capacity expansion will be a long time coming, but where demand is picking up. And a classic example of that in India is metals. So whether you look at non-ferrous or ferrous, in our country it's very difficult to put up new capacity for any type of metal processing. And as a result, as global prices run up for metals and domestic demand recovers, you're going to see 2, perhaps 3 years of bumper profits for the metals and mining sector. So that's a sector which I think there'll be plenty of price action, earnings impact, probably capital raises. Clearly in the NCLT process, there are a number of stricken processors, metal processors who will get disposed of, sold in the NCLT process. So a sector which I think will be in the thick of things over the next couple of years. Classic late cycle sector, metals and mining, and I think will be a center of a lot of action. Similarly, I think construction, road building, there's obviously one large company there and a range of smaller companies. The government has been clear that they will continue tendering roads at a brisk pace. The PSU banks, once they get their fresh capital, will also start giving working capital to the construction sector, to the road building sector, and my reckoning is we'll see plenty of price action. And finally, one sector which has done well over the last 3 years, which I think will continue doing well, is discretionary consumption. I think the GST rollbacks, we've had 2 very big rollbacks in October, November. I think the biggest tax cuts in 10 years is what I've called those rollbacks. Those will stoke discretionary consumption. I think there'll be more GST rollbacks in the coming next 6 months or so. So whether it's auto, whether it is jewelry, whether it is apparel, retail, I think discretionary consumption will continue to boom through the year, which is what you would expect in an economic recovery. The only sector I really worry about is these wholesale funded borrowers, the NBFCs, housing finance companies, and some.
Right. Saurabh, I'll have to interrupt you for a second there. Just for a second, I would want to come back to you for you to complete your point. But since we are talking about the cyclical, recovery being put in place, we have Dilip Bilkon that's just bagged an NHAI order worth 730 crores. So seems like those green shoots are for real. Rohan Suryavanshi joins us to talk more about that order. What can you tell us about this order, Rohan?
Hi, Tanveer. Good morning. So the order that we won is on the border of the state of Madhya Pradesh and Maharashtra. It's in a district called, a place called Siuni. It's part of the NH7. And the order is for about, we won it for about 730 crores. It's a 24-month order. It's a concrete road that we're building for about, it's about a 30-kilometer stretch. So this is great that the ordering that we've been saying that it'll come very heavily in the second half. It's all started, and this is just the start. There will be a lot more orders coming in, and as at the Bilkon we've maintained that we will win about 8 to 10,000 crores of incremental order this year. So we are on track to achieve that.
Right. Rohan, how much from the NHAI? Because we had the chairman a few days back highlighting that, their kitty for the year is about 10,000 kilometers. And I know you're talking about 30 kilometers over here, but how much more do you hope to garner from the NHAI alone?
So actually, we do not just look at NHAI, but we look at a combine of NHAI and MORTH, which is the Ministry of Road Transport and Highways. We put them together. Last year, both of them put together had bid about 16,000 kilometers of roads in total. This year we're expecting them to do a little more than that, maybe 18,000 kilometers or so. Personally, we just do not look at it in terms of kilometers, but in terms of the order value that we want to bid. So we will be now looking at a mix of both NHAI and MORTH, and we've already bid for a lot of projects and in the process of bidding for a lot more. So, but like I said, we are confident that we will end up winning about 8 to 10,000 crores of new roads this year, which will be a mix of both. MORTH actually has been more active than NHAI in terms of ordering in the last few years.
Okay, Rohan, appreciate your time and thank you for joining us. Saurabh, I'll take a leap from what we picked up from Rohan. The order for pure EPC builders, or the order books for pure EPC builders now seems to be swelling up. Last week we had the chairman of NHAI also, and he was pretty excited about how the Bharat Mala project and how the Bharat Mala things are progressing. So do you think we could be in for an earnings surprise and a strong P expansion for some of these EPC companies? Because Saurabh, I was looking at the data for HCC and NCC. For last 3 years, the top line and bottom line has been flat for some of these good EPC companies.
I'm not so sure how much of an earnings surprise they can generate in the next 9 to 12 months. But what's clear is order books will swell up enormously. So I think as a gentleman you had on air a few minutes ago is saying, I think that's what we are hearing from across the construction piece, that that there is growing anticipation backed by clear guidance from the powers that be in Delhi, that there will be a big swelling of order books, and some of these companies I think are even hitting the road to consider raising capital in the coming few months. So I'm not sure how much of that will translate into revenues straight off, because there will be some fiscal constraints that the center will face over the next 12 months as we approach the general elections. But certainly there will be plenty of tendering, and the banks will, especially the PSU banks, will give working capital lines for the construction work to kick off.
So let's talk about the good old topic of LTCG, a topic which we often discuss, debate and deliberate before the budget. So let's not change from our pattern, let's deliberate and discuss it this time as well. One of the basic premise why equities have done well is because they are tax free. If there is a tinkering in long-term capital gains, do you think that could act as an handicap for investors? Because frankly, one unique proposition for Indian stocks is you invest for more than 365 days, you get scot-free, you don't pay any taxes. That could certainly go.
So look, I mean, if the government were to say that that you need to hold for say 2 years or 3 years to get CGT exemption rather than the current 1 year, obviously it'll have some short-term dampening effect, because specifically I think income funds in our country have taken in lots of money on the premise that they'll be giving steady returns, and yet they get equity type taxation, which is if you hold an income fund for longer than 12 months. There's no CGT consideration. So there could well be a short-term impact. I'm not so sure tweaking around with CGT will have that much of a long-term impact in the Indian context. Where I think the government might be wary and apprehensive about changing the CGT rules now is if they're targeting heavy amounts of disinvestment next year, and I'm hearing from some sources that it could well be ₹1 trillion of disinvestment in the year to March 19. If you have that sort of disinvestment target in the penultimate budget before the elections, you probably don't want to be messing around with the CGT rules, because that could dampen appetite for equities. But I'm not so sure that even if they did, it's that big a deal in the longer term context. Sure, there could be some short term volatility, but I'm not so sure that given the underlying fundamentals of this country in the long run, and given overall attractiveness of shifting from physical assets like gold and real estate into financial assets like equities, I'm not sure tweaking the CGT rules will be that damaging in the long run.
Saurabh, give us your sense on what happens with the underperformers, especially the likes of, pharma and IT, where, one is watching out for earnings very closely, and even finding value for that matter in infrastructure, because we've spoken so much at length about how, the investment cycle could be picking up, and order books of a lot of construction companies swelling. I mean, I think it's either ways a lot of money chasing few quality stocks, because with infrastructure that's been an area of contention, right? Execution capabilities and funding these projects for timely implementation.
So I think that it's worth sort of saying that for the last 6 or 7 months that I've been on your channel, I've repeatedly said that the top layer of IT companies and mid-cap pharma are worth looking at, because there's clearly well-run companies who are sensibly valued. At least in the case of IT, that thesis seems to be bearing out. Our IT analyst Sudhir published a note last week saying that is Trump falling in love with Indian IT, and the reason we wrote that was it does seem that his initial hostility to H-1B visas, to the whole Indian IT services companies, that sort of blaze of hostility seems to be receding. And alongside that, there's obviously a concerted economic pickup across the Western economies, which is helping the Indian IT services companies. So I reiterate my view that amongst the top 4 Indian IT services, there's at least a couple where I think there's merit in buying and sitting tight. You don't get too many companies in our country with 30% ROC but trading at 16 times earnings, and when you do get these sorts of companies, I think it's worth buying in and sitting back and ignoring the noise. Large cap pharma has worried me over the last 12 months, continues to worry me, both because the regulatory environment I think is still in flux, and it's not evident that the whole FDA issues have dissipated. Mid cap pharma, we continue believing that there are attractive companies to buy there. I think the overall theme that will result in money coming into large cap IT and mid cap pharma is in small and mid cap. In a higher inflation climate, which is what we are heading into, in a higher inflation climate, you will see operating margin pressure on small and mid cap companies because their larger customers will squeeze them. If you are an auto ancillary supplying an auto OEM, your OEM customer will squeeze you this year, and as a result, I think investors will start checking some of that, some of their irrational exuberance vis-a-vis small and mid caps, and I think money naturally rotates into sectors like large cap sectors, like metals, like construction, and like IT. So that's the theme I think we need to look out for. The economic growth is clearly on the upswing, but so is inflation, and inflation, high and variable inflation, is an enemy of small and mid cap companies.
No, that seems to be the case. So where does that leave the cyclical story that we were touching upon a little while back? And it's not just about infrastructure, it's also about metals, right? We're talking about getting into a multi-year bull market for metals. What we've seen so far has just been a major catch-up rally because they were oversold into 2014, 2015, and so they've made a comeback from there. What can interest in metal stocks?
So as I was saying, right, the biggest attraction of the metal stocks is new supply will be a long time coming, and therefore you've got two dynamics which helps these metal companies. Global prices are picking up, and secondly, there's some modest demand pickup domestically, and therefore these come together to help the metal companies. Over and above that, especially in steel, you've got a dozen or so companies going through the NCLT process, and they'll get swallowed up presumably by the larger steel companies. So metals, road building, construction, consumer discretionary, even the CASA funded banks, whether they be public or private, I think CASA funded banks which have CASA ratios upwards of 40%, I think are well placed to benefit from the rally. The only element of cyclicals which one worries about is, as I was saying, the wholesale funded lenders. They struggle as inflation picks up and bond yields tighten. But barring that, cyclical should have a really good 12 months now.
What is the real way to look at metals then? I just want to extend your point there that new capacity addition is still a distance away, and a lot of existing capacity in China is getting mothballed. But ultimately it's all about demand. What is your understanding of the metal demand? Because the global economy is growing at about 3% plus, which means things are moving in the right direction. So can one be reasonably optimistic of the demand side for metals?
So I think one thing I've learned in my 15 years in the market is with cyclical stocks, and especially with cyclical stocks in capex intensive industries like metals, one shouldn't lose too much sleep trying to second guess the demand. It's difficult and often futile. The best time to buy sectors such as metals is when supply addition completely conks off, right? And that's happened in our country in the last couple of years. Just given the amount of land, amount of coal you need to add a steel plant in India or to add a zinc plant, I simply cannot see how there will be any supply response in the next couple of years, certainly not until the next general election. So the best time to buy cyclicals is when there is no supply response, incremental supply addition has conked off. In fact, there is supply getting mothballed in China and in India. The bankrupt companies in our country have also mothballed themselves. That's the best time to buy cyclicals and especially metals. Don't try to second guess the demand. Look at what data you have in supply, and I think the supply data clearly gives a buy signal on both ferrous and non-ferrous.
Saurabh, let me connect dots here, and I'll reverse positions here. Let me be the big bear for a change. cost of capital will go higher, inflation is making a comeback, and historically we've seen that every time when cost of capital goes higher, inflation goes higher, it will have an impact on market valuations and the positioning of the market. That's a genuine concern, Saurabh. But how long do you think markets will ignore it?
So look, I mean, you're right. I mean, the 10-year bond yield has gone up from 6.4 to say 7.2, 7.3 now, and if you invert the bond yield, that should give you the market PE multiple. That does hold true for over 3, 4, 5-year periods. What, however, happens in the final frenzy of any bull market, and whether it's in America, whether it's in India, in the final frenzy of the bull market, your bond yields go up and your PE multiples go up. So in the sort of most euphoric phase of the rally, people stop caring about fundamentals, whether it's bond deals or PE multiples, and it's basically euphoria and excitement driving the rally. I think that's the sort of phase you're in. I'm not saying that the market is sensibly valued. Clearly, the Indian stock market is overvalued. Clearly, the rise in bond deals over the last 4 or 5 months does suggest you should see market PE multiples coming down, not going up. But at this juncture, I don't think anybody's interested in listening to fundamental people like myself, or indeed more legendary fund managers like Jeremy Grantham, and hence his view. And what I'm seeing in India suggests that we are headed for the final frenzy of what for us has been a bull market which started in September 2013. We've more than doubled the index in September 2013. We're broadly we've had from 04 to 08 we doubled the market. In the last 5 years we've doubled the Indian stock market's market cap. But my reckoning is there's another 6, perhaps 12 months of fuel left in this frenzy where people ignore fundamentals, ignore bond deals, ignore PE multiples, and just buy because they're making so much money.
Appreciate your time. Thank you for joining us.